Hi guys, and welcome to this month's edition of Rise High Facebook Live. We are so glad that you can join us today, and we hope that today is of massive value to you. Today we're pretty excited. I've got Kristen Tunbridge here, who's one of our amazing Rise High mortgage brokers, and we are talking all about commercial and business finance. We haven't done a Facebook Live on this topic before, but it is one of the things that we specialise in at Rise High, and we do get a lot of inquiries and questions about commercial and business finance. So this episode is really specifically shouting out to all business owners out there, or people that want to own businesses, all entrepreneurs, or maybe even property investors who want to buy commercial investment property, and or investors that want to do some more sort of complex investment options, like investing in their self-managed super fund, for example. So we're going to touch on a lot of different areas, and it's really aimed at growing your knowledge about what the banks look for when they're looking at commercial and business finance, but also what type of finance products are available for business owners to help them manage their cash flow, to help them grow their business, and move forward and achieve their dreams and goals. And I am really glad that Kristen's here today, because prior to becoming a mortgage broker with Rise High, Kristen's worked for many of the big banks internationally and in Australia. And prior to starting with Rise High, she was in commercial credit at Westpac. So she's got a really good inside knowledge into what the banks look for when they're looking at commercial applications, and how you can position yourself and put your best foot forward to get the loan approval that you would like. Now, as always, we really love your comments and questions, so you can comment and question throughout the session. We'll be happy to answer any questions you have. You can either leave a comment below, or you can email the question to amanda@risehigh.com.au. We already did get a few questions through the week, which we will be answering today in the session. So thank you to those of you who have already sent in your questions. And we're really excited to get started. I guess just a bit of a side note before we get into it, just a reminder that we do have our property investment seminars, which are really popular, and we've got one coming up in May, which is all about subdivision and development. So if that's something that you're interested in, get involved in that and jump on our website and register. And we have a few more coming up over the course of the year. So I reckon we'll get into it. How are you today, Kristen?
Very well, thanks, Briss.
Thanks for joining us. Yes, it's very exciting. So, okay, what we're going to talk about here is we're going to break it up into, first I want to talk about what do banks look for, and then I want to drill down into the types of products, and then we might address some of the questions that have come through. Sure. Sound good?
Sounds fantastic.
Awesome. Sounds good to you? Excellent. Okay, so let's talk about what do banks look for. So it's a little bit different to residential lending. It's a bit more case by case. So what do banks actually look for when they're looking to approve a business or commercial loan application?
Okay, so I think the easiest way to remember this is banks look for the 5 C's, and I guess how your business meets those criteria. So they are character, capacity, collateral, capital, and the conditions.
I like that, the 5 C's.
Yes, easier to remember. Got a good ring to it.
Got a good ring to it. So let's just go through those in detail and just really explain what each one is. So I think the first one was character.
Yeah, so character is looking at your business plans and your goals, and I guess where you're planning on heading. And it also looks at the experience that you have within the industry that you operate in. So
okay, so would it be fair to say that, if you're about to embark on a large property development and build an apartment building, the banks will want to see that you've had experience doing that previously.
Absolutely. Yeah.
Or if you're going to buy a fish and chip shop and run that, they would want to see that you've had experience managing fish and chip shops or something of that nature, so that you can prove that you have the capacity and the character.
Yeah, absolutely.
And I guess with character, does that also come down to, how the applicant is conducting their accounts, and how the applicant is, managing their finances currently?
And their cash flow, and making sure that there are no late or overdue payments on their existing facilities before they go out and try and get finance for something else.
And I think along that line, it would be fair to say that an applicant that comes across as really well prepared and will like a well thought through plan.
Absolutely, has a business plan in place that they're checking their actual financials up against and making sure that they're tracking really well, will definitely go a long way with a commercial.
Yeah, that would
application.
definitely add to the application.
Absolutely.
Okay, so that's character. That's the first C.
Yep.
What's the second C?
The next one is capacity. So this is where the bank looks at, why do you want the money? What's the purpose of the funds? And making sure that the new facility will actually assist with cash flow and better your business at the end of the day.
Okay, so they want to make sure, and I guess with capacity, does it also cover the business's ability to be able to repay the loan?
Absolutely.
And meet the obligation? So I guess really they're looking to make sure that they're when they give you the money, it is going to solve your problem and it is going to give you the ability to actually
meet your goals.
Absolutely. You know, whereas if you're wanting to build a new warehouse and you only apply for 100,000 but you need 400,000, then the bank's going to say, well, if we give you 100,000, it's not really going to work.
Absolutely.
So, okay, well that makes sense. So we had character, we had capacity. Third C. What's a third C?
It's collateral. So this is basically looking at what are you going to provide as security for the new loan. Lots of different options in the commercial world, whereas in, I guess, residential mortgage lending, you're just looking at the residential property.
Residential house. Yeah.
So with commercial lending, you've got lots of different options. You can use property, whether that's commercial or residential. You can look at providing the actual equipment that you're purchasing as security. You can do unsecured lending, which in most cases the banks will take what they call a fixed and floating charge over the business.
And maybe even a director's guarantee.
Absolutely.
Like a personal guarantee from directors, depending on the situation.
Yeah, and a lot of the scenarios where you provide safer security, you're potentially going to get better interest rates.
Okay, so I guess the banks have different levels of risk attached to each type of security.
Absolutely. Yeah.
So the more comfortable they are with the security, probably better interest rates, but also the more they might be able to borrow.
Exactly. Yeah. So the higher loan to value ratio they'll be able to accept for that.
Okay, great. So we've had character, capacity, collateral.
Testing your memory.
Yes.
The next one on the list
number
is
4.
Capital. So that's
Capital.
basically just looking at your level of gearing. How much debt do you currently have in comparison to the equity that you've got within your business?
Okay, great. So that's, I guess, just going on the comment that I just said, is that the better security you can offer the bank, probably the more you can borrow against it.
Absolutely.
So that's pretty self-explanatory. And what's the final C?
So the final one is a bit of a overall topic. It's looking at the conditions. So it's understanding the environment that you operate within, looking at your competitors within the market, as well as external market forces that may be impacting your business.
Yep, awesome. So we've got the 5 C's again. Let's just recap them one last time before we move on to the next section. So take us away, Kristen.
We've got character, capacity, collateral, capital, and conditions.
Awesome. And before we move on to the next section, I just want to do a shout out to Rue, Jeff, Susan and Todd. Thanks so much, guys, for tuning in. We really appreciate you giving us your time today. And I hope you're getting value out of the session. So let's now move on to the different types of loans that people can apply for. Business owners can apply for. So let's talk about the most common one, which I guess would be a term loan, which I guess is like a commercial loan. In the residential space, we would call it a home loan or an investment property loan. In the commercial space, it might be a commercial property loan or something like that. Mm-hmm. So can you just explain what this type of loan is and how it works?
Sure. So I guess this one's fairly comparable to a residential mortgage. Usually secured by property, you have set repayments. The term does depend on the nature of the asset being purchased, but usually up to around 20 years.
Okay.
So fairly comparable to a mortgage.
Yep, so it's kind of... So would this be appropriate for someone who is looking to buy a commercial property?
Absolutely.
Maybe they're running a business and they're currently renting their premises and they want to buy a premises.
That's exactly what you'd be using
get, a term loan?
Yep.
Okay, great. Okay, well that's a term loan. So let's move on to an unsecured business loan that's not secured by property.
Yeah, so this one, as we said, is not secured usually by anything material. However, in a lot of scenarios, the banks will take a fixed and floating charge over the business and potentially director's guarantees.
So what does a fixed and floating charge actually mean?
So it's an all-encompassing charge over the business, where I guess the bank can take ownership of the assets and the cash flow attached to the business if something was to go wrong.
Yeah, okay. So I guess there is you do need to still watch out for that, and there is a bit of a risk associated with
Absolutely.
it, but it's important that I guess that's, at least you're getting the loan.
An option. They tend to be a little bit more expensive and tend to have much shorter terms than, say, your term loan, which can go up to 20 years. So.
But I guess that could be a good option for someone that's looking to buy a business, buy an established business.
Absolutely.
They may not have the security to offer, but they may be looking to buy a business that's already trading profitably. That could be an option for them.
Yeah, they've got historical financials that they can provide to the bank that will show they've got a way of repaying the loan. So.
It could also be a good option for a business looking for some capital or some money for growth.
Yes.
Perhaps they want to, grow an area of their business, and they need to
provide some fairly strong, cash flow projections to the bank, just to prove that they can pay that loan back within the required term.
Yeah, beautiful. Okay, so we've talked about term loan, we've talked about an unsecured business loan. Let's now talk about a pretty common one that most businesses have, which is an overdraft.
Yeah.
Many businesses that I know have an overdraft. They don't necessarily all use the overdraft in the way that it should be used. Mm-hmm. So I'd love to just talk a bit about an overdraft and explore that a bit further.
Sure. So an overdraft facility tends to be used to fund working capital of the business. So you're not using an overdraft to buy equipment or fund longer term debt. It tends to be a little bit more seasonal and be able to help with the day-to-day, operations of the business. Overdrafts, usually you only pay interest on the facility. So instead of having set repayments, you just repaying interest on the amount that you're owing at that point in time.
And I guess, in my experience from banking, I've seen a lot of businesses that use their overdraft sort of always stays in debit, and it never really goes up to, it sort of doesn't fluctuate between credit and debit, which I think is what an overdraft should really do. It should fluctuate between credit and debit. So I guess if you do have that, if you are a business owner and you've got that lingering debt in the overdraft that never seems to go away, should the business owner consider shifting that debt to more of an unsecured business loan or a different type of debt facility that might be a bit cheaper?
Might be a bit cheaper, and will also usually have principal and interest repayments. So the bank will ensure that you're gradually bringing that debt down rather than just having it sit in your overdraft at a much higher interest rate for a long period of time.
Yeah, I think that's a really good strategy. So
Absolutely.
That's
something worth reviewing.
Definitely. So that was a term loan, unsecured business loan, and an overdraft. Just before we move on to the next one, a shout out to Carly, Tom, and Sasha. Thanks for joining us today. Really appreciate you tuning in. So we've just talked about term loan, unsecured business loan, and overdraft, but let's move on to something a little bit more interesting, which is invoice or debtor financing. Different banks have different names for this, but let's explain what that is and how that might work for a business.
Sure. So invoice finance tends to be for a business that supplies products or services to other businesses. So they're sending out invoices for their goods. They may have long payment terms on those invoices that they're sending out, say 30 or 60 days. And that can sometimes make it really hard to manage the cash flow of your business. So one option is whereby the bank will fund those invoices or a portion of those invoices really quickly. Say you send the invoice out and the bank will fund a portion of that invoice within 24 hours to help with your cash flow. And then in 30 days' time, when that invoice is due, the money just goes straight back to the bank rather than coming through to you.
Yeah, it's a really interesting product. And in many cases, it can be cheaper than an overdraft.
Absolutely.
Because it's actually got a tangible security that the bank is attaching to that, which is the invoices.
Yeah.
And it's a really interesting product. For the right business, it can be really effective.
Absolutely. And it will fluctuate with the amount of invoices that you've got outstanding at that point in time. So it's quite, can be quite seasonal as well and really help those types of businesses.
So that would be really good for businesses which have to pay, wages and have to pay for supplies long before they're going to get the money from their customer. So it helps bridge that gap.
Absolutely. It's a really good
and manage the cash flow. Yeah. Okay, well, that's really interesting. Let's move on to equipment finance, because many of our clients who are business owners, need to buy equipment for their factories, their warehouses, and their motor vehicles, trucks, stuff like that. So let's talk about equipment finance.
Yeah, absolutely. So exactly as it said, it's used to finance equipment. It's usually secured by that equipment, and depending on what it is, sometimes the bank will also request directors' guarantees. These facilities tend to match the timeline of the actual
machinery or
that's being
equipment.
Purchased.
Yep.
So usually between, up to about 7 years.
Yep.
And one other thing that the bank can do is have what they call a balloon payment at the end of the term. A balloon payment's basically where you have an amount outstanding. Say you have purchase a car, you have a 5-year finance term, and the balloon will be a payment at the end that's basically in line with what the value of that car is after 5 years.
Yeah, that's a really interesting point, because I often find that people are unsure of what to make the balloon, because generally yourself as the applicant can decide what you want the balloon to be. But it is a bit confusing knowing, well, how much would the balloon be? Should it be zero? Should it be an amount? And that really probably depends on what they're going to do at the time when the facility expires.
Yeah.
If it is a car, for example, which is a good example, are you planning to trade it in once you reach the 3-year mark or the 5-year mark, at what point the balloon is? And if you are planning to, then you need to make sure that the trade-in value is going to be more than what the balloon is, so that you can make sure that you can pay out the balloon figure. So that's a really interesting point, I think. Awesome. Full of knowledge, Kristen. So glad to have you on the show today. Okay, let's talk about one that's probably a little bit less common, but it is still something that is available, which is insurance premium funding.
Yeah, so I guess this is a really convenient and flexible alternative to paying insurance premiums up front. So if you're a business that has large, say, annual insurance premiums that have to be made in one lump sum payment, a bank can help you here, have a fixed interest rate attached to the facility and break it down to, say, 12 monthly repayments to help you manage the cash flow for that one.
Awesome. Okay, well that covers most of the main ones. There are other products that different lenders provide, and they're, special products that specialise for businesses that are exporting, importing. There's all sorts of different things, but at least we've covered the main ones today. And we would be happy to answer any questions that you have to specifically suit your own business, but at least we've covered the main ones today. Yep. So I'll just quickly recap. So we've covered term loan, unsecured business loan, we've covered overdraft, we've covered invoice debtor finance, we've covered equipment finance, and we've also touched on insurance premium funding. So now I'm going to actually get into some of the questions that we got sent through the week and see if we can help these people to identify where they sit and what sort of finance they need to look for. So let me get my questions out. So the first one was from George. George wanted to buy an existing franchise chicken and chip shop. The business is already trading and running successfully. He doesn't have any security that he can offer, but he can put a small cash deposit into the transaction. So how can George get the funds that he needs to buy his franchise chicken and chip shop? Okay,
this is a perfect question for an unsecured business loan.
Yep.
And in particular, you'd probably want to investigate a bank that had a policy to do with franchises.
Yeah, so we do have a few banks that...
Yeah, they really do specialise in that area of lending and understand what's required. So in that scenario, he would have some historical financials, have some data to back up the application and be able to show the cash flow. So I think that would be a really good option for George.
Okay, thanks for the question, George. Hope that helps. Next one is from Derek. So Derek, he says, my customers are on 30-day payment terms, but cash flow can sometimes be hard to manage because I have to pay for stock and pay my wages and well before receiving the money from my clients.
Mm-hmm.
So how can we help Derek?
So perfect one for invoice finance there, Derek. It's where the bank will be able to release some money to you really, really quickly on providing the invoices to the bank. and help you with your cash flow on day-to-day basis.
It'll definitely ease that burden in the short term, won't it?
Absolutely.
Yeah. Hope that helps, Derek. Thanks for the question. Next one is from Andrew. So Andrew wants to buy a new car for a staff member and he wants to get a car loan. His question is it cheaper to get this in personal name or business name? Can you please explain how the balloon works and how I determine what the balloon amount should be? We've covered a little bit of that, but we'll just cover it again for Andrew. So let's start with the question that he says, is it cheaper to get this in personal name or business name?
Look, we do tend to find it is cheaper to get it in the business name. That's where we're able to go out to a few different lenders and get some quotes for you. But ultimately you will find that the business name is a cheaper way of doing it.
Yep, awesome. Okay, the second part was about the balloon, how the balloon works and how you determine the balloon amount. So we have covered this already a little bit, Andrew, but should we just quickly touch on it again?
Yeah, I guess for motor vehicles, there are a couple of websites around whereby you can punch in the details of the specific vehicle and it will give you an estimated price of that vehicle within that time frame. So it's a really good starting point, having a bit of a shop around on carsales.com. And then I guess matching the balloon to the amount that's...
And possibly even the, where you actually buy the car from.
Yeah,
could give you an estimate of a trade-in value at that point in time. So there are different options of ways to work it out. But, I also find that a lot of clients do rely on the assistance of their accountant to help them determine their balloon if they're a bit stuck. So there's lots of different ways of doing it, but it is important to make sure that the balloon is not worth more than the car will be worth at the time the balloon becomes payable. So that's the main thing really there, because then you'll be left with a bigger debt and, you might sort of find yourself in a bit of a pickle then, won't you? So that hopefully that helps, Andrew. We'd be happy to answer any more questions you have. Next one is from Vanessa. Vanessa says, my husband and I run a medium-sized business and are currently leasing a commercial premises for our business, but we want to explore buying an office space to move into. We do have a fair bit of equity in our home. Should we use the equity in our home or just use the new commercial property as security? Is this something we should consider doing in our SMSF? So that's a pretty big question. So let's try and answer that one for Vanessa.
So look, I guess at the moment, interest rates are fairly similar with regards to securing the debt with your residential property or your commercial property. So
yeah, we're getting some pretty good rates on the commercial side at the moment, aren't we?
So worth exploring both options. Or you can do a combination of both. So instead of having to put up a cash deposit to buy the commercial property, you could have a majority of the debt secured by the commercial property and then use the equity in your residential property to
fund the
deposit.
Yeah, so that would be good to make, allow, I guess that would help, that would increase tax deductions.
Yes, exactly.
For the commercial lending, because you have a bigger loan against the asset, and also means that you don't have to use any of your own cash.
Yeah, exactly.
So that's nice. So if you've got a home loan, you can put your cash in your home loan, and so that seems like a good strategy. And there was a second part of the question, which was, is this something we should consider doing in our SMSF?
So look,
that means self-managed super fund, just to confirm.
So I guess the self-managed super fund option is really popular at the moment, and it does have a lot of advantages, but it's probably something that you want to sit down with a financial planner to explore the options. And then, of course, if it is the right option for you, we can help you with the funding for that commercial property.
And it's pretty popular these days that people buy their business premises in their self-managed super fund. There's a few sort of benefits there of doing that.
Absolutely.
So, okay, Vanessa, hopefully that answered your question and that's helps you out. Before we move on to the last question today, we have a shout out to Ali, Jeff and Todd. Thanks for tuning in today. Really appreciate it. And okay, so we do have another question from Thomas. So thanks for your question, Thomas. Thomas says, my business is very seasonal and fluctuates at different times of the year. This can make cash flow management tricky. What would you suggest?
I think for anything where the word seasonal comes up, an overdraft is a really good option for that type of scenario. Basically, you're only going to pay for what you use. So during the quiet periods, you're not going to have, big cash outgoings to, say, fund an ongoing facility. Whereas with an overdraft, you're basically just paying what you use. So that's a really good option.
Yep, awesome. Hope that helps, Thomas. That brings us to the end of the questions for today. Really wanted to say a huge thank you for tuning in today. Thank you so much for joining us. We hope that you found value out of the session today. If you do want to find out any more about commercial and business finance, it is one of our areas of specialisation. So please feel free to contact us anytime, and we'd love to find a solution for you. And we really appreciate your time. So thanks to Kristen for joining us today. And we hope to see you at the next month's episode of our Facebook Live videos. Thanks, guys. Bye.